Hello everyone, wherever you are, a retail forex trader or a beginner, let me share with you something that took me years to understand. And it changed everything. Most traders think that success comes from finding the right setup or mastering the right pattern or learning some secret technique that the professionals know. But that is not where success comes from. Actually, let me tell you something. Forex trading is risky and 80% of retail forex traders lose their capital in the market. Success in trading comes from understanding your own mind, and more specifically, understanding how position size affects your ability to think clearly. I spent decades working with traders, successful ones, struggling ones, brilliant ones who failed, average ones who succeeded. And I noticed something consistent. The traders who survived were not necessarily the smartest. They were not the ones with the most complex systems. They were the ones who understood the relationship between risk and psychological clarity. Let me explain what I mean. When you first start trading, you bring certain beliefs with you. Beliefs about what success looks like, beliefs about what it means to be good at something. In most areas of life, bigger is better, more effort equals more results. Intelligence should be rewarded, hard work should pay off. These beliefs are deeply wired into us, so when we come to trading, we naturally assume the same rules apply. We think that bigger trades mean we are more committed, more confident, more serious about making money. We look at a small position and we feel like we are playing it safe, like we are not really trying, like we are being timid or afraid. And we look at a big position and we feel powerful. We feel like we are finally doing something that matters. Like this trade could change our account, change our life. But here's the problem. The market does not care about your feelings. It does not care about your confidence. It does not reward effort or intelligence or commitment. The market simply moves according to probabilities. And your job is to align yourself with those probabilities, or not to prove something, not to make a statement, but to execute your edge over and over again without interference. And interference comes from emotion. And emotion comes from risk that is too large for your nervous system to handle. Let me describe what happens inside your mind when you put on a trade that is too big for you. At first, you might feel excited, energized. This is it. This is the trade that is going to make a difference. But then the market moves. Maybe it moves against you slightly, or maybe it moves in your direction, but then pulls back. And suddenly, something shifts inside you. Your breathing changes, your focus narrows, you start watching every tick, every candle becomes personal. Every move feels like it is saying something about you. This is not trading anymore. This is survival. Your brain has detected a threat. Not a physical threat, but a threat to your sense of security, your sense of self, your sense of being okay. And when your brain goes into survival mode, it stops being rational. It stops following rules. It starts making decisions based on fear and urgency. You start thinking thoughts like this. I should have taken profit when I had the chance. I cannot afford to lose this trade. Maybe I should move my stop just a little bit. Maybe I should get out now before it gets worse. These thoughts feel logical in the moment. They feel like you are being smart, protecting yourself, making the right decision. But they are not logical. They are emotional reactions disguised as logic. And the reason they are happening is not because your strategy is wrong. It is because the risk is too large for your mind to handle objectively. Here's something most traders do not understand. Your ability to follow rules is not a character issue. It is not about discipline and the way people think. It is about whether your nervous system feels safe enough to let you follow the rules. When you're calm, following rules is easy. You know what to do. You trust your system, you execute without hesitation. But when you are afraid, following rules becomes almost impossible because fear overrides logic. It is designed to. That is how survival works. If you're being chased by a predator, you do not stop and think about the best strategy. You run, you react. You do whatever feels necessary in the moment to survive. And when your position size is too large, your brain interprets a losing trade as a predator, it interprets drawdown as danger, and it takes over your decision-making to protect you. This is why traders make the same mistakes over and over, not because they do not know better, but because they are trading in a state where their brain will not let them do better. And let me walk you through the most common mistakes that come from oversized risk, because I saw these patterns in almost every struggling trader I worked with. First, hesitation. When the risk is too big, you start second-guessing your entries. You see your setup, you know it is valid, but you hesitate. You wait for more confirmation, you talk yourself out of it, and then the trade works and you feel frustrated, angry at yourself. So you promise to take the next one, but the next one also feels risky. So you hesitate again, or worse, you take it late after the best entry is gone, and then you get stopped out. This creates a terrible cycle. You cannot trust yourself, you cannot execute with confidence, and your results suffer, not because your strategy is bad, but because fear is controlling your timing. Second, moving your stop loss. This is one of the most destructive habits in trading, and it almost always comes from having too much risk on the line. You place a trade with a logical stop, a stop that is based on market structure or volatility or your system rules, and at the time it feels reasonable, but then price approaches your stop, and suddenly that loss feels unbearable. You cannot accept it, so you move the stop a little further away. You tell yourself it is because you believe in the trade, but that is not the real reason. The real reason is that the loss is too painful to accept, so you do whatever you can to avoid it, and sometimes the trade comes back and you feel relieved. You feel like you made the right choice, but most of the time it does not. And by moving your stop, you turned a small loss into a larger one. You violated your risk management. You created a pattern that will destroy your account over time. Third, cutting winners early when you have a big position on profit feels fragile. It feels like it could disappear at any moment. So when the trade moves in your favor, you feel this intense urge to lock it in, to take it off the table before the market takes it back. You exit too early, and then you watch the trade continue without you and you feel frustrated. But you do not realize that this is not a targeting problem, it is a position size problem. If the position were smaller, you would not. Feel that urgency, you would let it run. You would let your edge play out. Fourth, holding losers too long. This might seem contradictory, but it is actually the same issue. When a trade goes against you and you're risking too much, you freeze. You cannot pull the trigger. You hope it will come back. You tell yourself it is just temporary. You hold through your stop. You hold through your rules. You hold because accepting the loss feels like failure, and by the time you finally exit, the loss is much larger than it should have been. All of these mistakes come from the same root cause. The position is too large for your mind to handle, and your mind is trying to protect you in the only way it knows how, by taking control away from your rules and giving it to your fear. Now let me tell you what happens when you trade with a smaller position size, a size that feels almost too small, a size that does not make your heart race first. You become emotionally neutral. When the risk is small enough, the trade stops being personal. It is just another execution, just another opportunity for your edge to express itself. You place the trade and you do not obsess over it. You check it when you need to. You manage it according to your rules, but you do not attach your identity to the outcome. This is the state where good trading happens. Second, you can follow your rules without internal conflict. Your stop makes sense, and you honor it. Your target makes sense, and you let the trade get there. Your entry criteria are clear, and you execute them without hesitation. There's no voice in your head arguing with you, no emotional negotiation, just calm execution. Third, you let probabilities play out. This is the most important part. Trading is a probabilistic game. Your edge is not that you win every trade. Your edge is that over a series of trades, your system produces more profit than loss. But for that edge to work, you have to let it work. You have to execute the system over and over without interference. And the only way to do that is to trade at a size where each individual trade does not matter too much. When each trade is just one in a series of hundreds or thousands, you stop trying to control the outcome. You stop needing to be right. You stop caring whether this specific trade wins or loses. You just execute, and you let the numbers do what they are designed to do. Fourth, consistency becomes possible. With small size, you can trade the same way every day. You can show up calm, you can execute without drama, you can build a track record that is based on process, not luck. And over time, that consistency compounds, not because you are taking huge risks, but because you are avoiding huge mistakes. Let me talk about ego for a moment, because this is where most traders get stuck. Trading with small size feels like you are not trying hard enough. It feels like you're settling, like you are playing it safe. And for someone who is competitive, who is used to pushing themselves, who wants to succeed, this feels wrong. You think that real traders take big risks, that confidence means betting big, that playing small is what losers do. But this is your ego talking, not your rational mind. Your ego wants to feel significant. It wants to prove something. It wants to win in a way that looks impressive. But the market does not care about any of that. The market rewards the trader who can remove ego from the equation, the trader who can execute without needing to feel powerful, the trader who can accept small wins and small losses and just keep going. Here is the truth that your ego does not want to hear. Trading is not personal. The market is not testing you. It is not judging you. It is not rewarding your confidence or punishing your doubt. It is just moving according to probabilities. And your job is to participate in those probabilities without distorting them with your emotions. When you take a big position, you're making it personal. You are turning a probabilistic event into a referendum on your worth as a trader, as a person, and that is a game you cannot win. There is another reason traders gravitate toward big positions. They think it gives them control. If I risk more, I can make more. If I am focused, if I am confident, if I am prepared, I can make this trade work. But this is an illusion. You do not control the market. You do not control what happens in the next 5 minutes or the next 5 hours. You do not control whether this specific trade wins or loses. All you control is your execution, your risk, your response, and the bigger your position, the less control you actually have. Because the bigger the position, the more your emotions interfere, the more you second guess, the more you deviate from your plan. Small size is not giving up control. It is actually reclaiming control. Control over your mind, control over your process, control over your ability to stay in the game long enough for your edge to work. Let me share something I learned over many years, something that separates the traders who make it from the ones who do not. The goal is not to make money, not at first. The goal is to survive. Survival means staying in the game. It means not blowing up your account. It means not quitting because you are too emotionally damaged to continue. And survival requires humility. It requires patience. It requires you to prioritize process over results. When you trade with big size, you are prioritizing results. You're trying to force the market to give you what you want, and the market does not respond well to force. But when you trade with small size, you are prioritizing survival. You are saying, I am going to protect my capital. I'm going to protect my mind. I'm going to give myself the space to learn and grow and build consistency. And over time, survival leads to profit, not because you are taking big swings, but because you are compounding small edges without self-destructing. Let me talk about compounding for a moment, because most traders misunderstand it. They think compounding is about making huge returns, about doubling your account every month, about getting rich fast. But that is not what compounding is. Compounding is what happens when you can execute consistently over a long period of time without blowing up. It is the natural result of staying in the game, of not making catastrophic mistakes, of letting your edge express itself over hundreds or thousands of trades. And the only way to do that is to trade at a size that allows you to stay calm, to stay rational, to stay consistent. When you're trading too big, you interrupt the compounding process, you have a good week, then you give it all back in one bad trade. You build your account, then you destroy it, trying to force a big win. But when you trade small, you create the conditions for compounding to actually work because you are not sabotaging yourself. You're not letting fear or greed derail your process. You are just showing up day after day, trade after trade, letting the numbers do their thing, and over time, that adds up to something significant. Not because any one trade was significant, but because you were able to stay in the game long enough for the edge to work. Here's something I want you to really understand. Your edge is not about being right. It is about what happens over a series of trades. A good system might win 50 or 60 or 70% of the time, but even a 70% win rate means you lose 30% of the time. And if you're trading too big, those losses will destroy you. They will shake your confidence, they will make you question your system, they will cause you to deviate from your rules. But if you are trading small, those losses are just part of the process. They do not hurt, they do not mean anything, they are just data points in a larger statistical outcome. And when you can accept losses as part of the process, you stop trying to avoid them, you stop moving your stops, you stop hesitating, you stop cutting winners early to avoid potential losses, you just execute and you let the probabilities play out. And that is when your edge starts working, not because you forced it, but because you stopped interfering with it. Let me tell you what I learned from watching successful traders. They are not the ones who have the most exciting stories. They are not the ones who made a fortune on one trade. They are not the ones who took huge risks and got lucky. They are the ones who are still here, still trading, still consistent, still calm. They are durable. And durability comes from trading in a way that does not burn you out, that does not trigger your worst impulses, that does not put you in a position where one mistake can end your career. Excitement is overrated. Excitement is what gets traders into trouble because excitement is just another word for emotional intensity. And emotional intensity is the opposite of what you need to trade. Well, what you need is calm, clarity, consistency, and you get that by trading at a size that feels boring, a size that does not spike your adrenaline, a size that lets you focus on execution instead of outcomes. Let me bring this all together. Trading is not about making money, not directly. Trading is about executing a process that has an edge, a process that works over time. And your job is not to control the outcome of each trade. Your job is to execute the process as cleanly as possible, without interference, without deviation, without letting your emotions hijack your decisions. And the only way to do that is to remove the emotional intensity from your trades. And the only way to remove the emotional intensity is to trade at a size that does not trigger your survival instincts. When the risk is small, you can focus on the process. You can ask yourself, did I follow my rules? Did I execute my system? Did I manage the trade the way I was supposed to? And if the answer is yes, then the trade was a success, regardless of whether it made money or lost money. Because in the long run, good execution leads to good results. Not perfect results, not every trade being a winner, but good results, consistent results, results you can build on. Here's a question I want you to ask yourself. What does success look like? For most traders, success is measured by profit, by how much money they made this week or this month. But I want you to measure success differently. Measure it by how well you executed, by how calm you stayed, by how closely you followed your rules, by how little emotional interference you had. Because if you can execute well, the profit will come. Not immediately, not on every trade, but over time. And if you cannot execute well, the profit will not last. You might get lucky for a while, but eventually the emotional mistakes will catch up with you. So stop measuring yourself by outcomes you do not control, and start measuring yourself by the process you do control. Did you trade at a size that allowed you to think clearly? Did you follow your rules? Did you manage your risk the way you were supposed to? If yes, then you succeeded even if the trade lost money, because you are building the habits that lead to long-term success. Let me tell you what happens when you finally embrace small position sizes. You feel free from the constant anxiety, free from the obsessive monitoring, free from the fear of ruin. You can place a trade and walk away. You can let it work without needing to control it. You can take a loss without feeling devastated. And that freedom changes everything. Because when you are free from fear, you can finally trade the way you're supposed to. You can see the market clearly, you can execute without hesitation, you can follow your plan without internal conflict. And that is when trading becomes what it is supposed to be. Not a battle, not a test of your worth, but a calm, methodical execution of a process that has an edge. I want to leave you with this. Trading is hard enough without making it harder on yourself. The market is unpredictable. Your edge is probabilistic. The outcomes of individual trades are random, but your process does not have to be random. Your execution does not have to be chaotic. Your emotions do not have to control you. You can create an environment where good trading is possible, where you can execute your system without interference, where you can let your edge work overtime. And that environment starts with position size. Trade small, smaller than feels significant, smaller than feels exciting, small enough that you can stay calm, small enough that you can follow your rules, small enough that you can survive. Because survival is the foundation of everything else. And if you can survive long enough with enough consistency, the results will take care of themselves. Not because you forced them, but because you created the conditions where your edge could finally express itself. That is the truth about position size, and it is the truth that will change your trading if you let it. If you found this helpful, hit that like button, subscribe for more content, and let me know in the comments below on how you're going to change your trading mindset first. Thanks for watching, and I'll see you in the next video.